Palantir stock. This is going to be the first subject of today's video. I posted in my private stock group's Discord chat on the Palantir chat. I posted a little 56-second clip that was essentially posted on X yesterday from this gentleman talking about Palantir as the greatest investment opportunity out there. And I thought he did a very good job of summing up Palantir in this little clip here. So I want to react to that, kind of talk a little bit about Palantir in this video here today. Then we're going to react to this one from 40 minutes ago on CNBC, the race for the Robotaxi. I think that should be a fun one to obviously react to, given what transpired yesterday with the Tesla event, right? Consumer spending falls in September after 7 straight months of gains. Looking forward to reacting to that one here. And then last one up here, NVIDIA is our most controversial and biggest opportunity, says Goldman. That seems interesting. So, alrighty, guys. Appreciate you joining me as always, by the way. Thank you, everybody. Thank you for being subscribed. 51,200 plus subscribers, I think, strong on the channel. Thank you, everybody that smashed that thumbs up button as well. Pin comment down there. I'll put my Instagram and I'll put my X. If you want to follow me on Instagram or you want to follow me on X, I'll put that as the pinned comment down there today, okay? So, this one, let's go ahead and watch this together.
Continues. I've got to ask you about Palantir. You said it's the greatest investment opportunity of all time, your lifetime. The stock hasn't moved that much, though.
Yeah, well, Stuart, it's got an incredible valuation. So for a company that does $3 billion in revenue within...
Hold your horses, sir, for just a moment. The stock hasn't moved that much. I don't know. I don't understand what we're talking about. Palantir's up 158% year to date. In the past 1 year, Palantir's up 138%. On a 6 month, is up 89%. On a 3 month, is up 52%. On a 1 month, it's up 24%. On a 5 day, it's up 7.4. It's 7.8%. So I'm not exactly sure what he's referring to there. But that's interesting. By the way, SoFi is all of a sudden catching a bid here recently on a 5 day, 7.7% up on SoFi there. But let's get back into this. That was just interesting about, like, what?
Yeah, well, Stuart, it's got an incredible valuation. So for a company that does $3 billion in revenue with an $80 billion market cap, it's expensive.
Yeah, very.
But the way you have to think about it is, I'm thinking of more of it like a Tesla. So if you could have bought Tesla 7 or 8 years ago, that had an astronomical valuation because of what lies in front of it. So the addressable market, the software services it could cover, is somewhere in the hundreds of billions of dollars. So between 100 and 200 billion. So this company's revenue over the next 5 years, 10 years could grow 5x, 10x, 20x, 30x, because it's the software that sits at the fulcrum point of artificial intelligence. So you're building up all this firepower and all this computing power with your NVIDIA chips and your Amazon cloud, your Microsoft cloud. To actually implement it in your business, you need software that's excellent. Nothing like Palantir exists.
Real fast, before the market.
I think this rally continues.
I've got to ask you about Palantir. You said
I think he put that very well in regards to Palantir. And he also mentions about valuation, which is why everybody goes so mad in regards to the stock, because they're looking and they're like, come on, man, $100 billion market cap. The company's going to do $3 billion of revenue or so, right? And so they're looking at it and they're like, my gosh, it's just so expensive. You look at a forward P, it's over 100 now at this point in time, right? And so people are like, gosh, the valuation's so much. But you got to understand, if Palantir is going to grow their revenue if we can assume a 30-35% revenue growth rate over the coming years, and the earnings per share is going to increase at a much faster clip than that, and the net margins are going to be top tier over this next 5 to 10 years, well, guess what? In that sort of situation, Palantir is actually not an expensive stock here, right? Now, if Palantir only grows revenues 15 to 20%, yeah, it's going to be dead money for several years. There's no doubt about that. Like, Palantir revenue growth of 15-20% a year will be dead money for the next 3 years probably, right? But assuming they are that company, which if you're that company, you're going to start growing revenues 30% plus clips, they're still a buy, even here, which is crazy, right? Now, I went super in depth in regards to Palantir on the main channel 4 days ago. Palantir stock is about to, okay? Talk about shock and awe. That's when the stock was $40 right there. I went very in-depth on Palantir, valuation, 33-minute video there. So if you want my super in-depth thoughts on Palantir, watch that video there on the main channel. That will definitely help you out in regards to that one. The race for the Robotaxi.
Tesla and Uber's Robotaxi ambitions, but remember, it's likely Alphabet's Waymo that's leading the driverless race at this point. Deirdre Bosa brings us more on that angle in today's Tech Check. And speaking of the competition that Connor was alluding to, Deirdre. Yes, I really enjoyed that last conversation. My takeaway is that CEO Dara Khosrowshahi has done really an incredible job of putting Uber adjacent to robotaxis, but that is just it. It's adjacent. Uber does not have the tech itself. It's just a network that could still be disrupted. So the real winner from last night is Alphabet-owned Waymo. While Tesla hopes to start production on our Cybercab before 2027, Waymo already has a fleet of more than 700 driverless vehicles, no safety driver, delivering and charging for thousands of rides per week, and it's expanding rapidly. Now, the two key ingredients.
So this is very important. And me as a Tesla shareholder, and by the way, I just started buying Google stock, but it's like literally nothing, especially compared to my Tesla position. It's like a few $100 so far, right? Compared to hundreds of thousands of dollars I've invested in Tesla. I have to be honest with you guys. This is what I've been saying. Like, Waymo's ahead. Waymo's ahead. There's no debating that. There's no could Tesla leapfrog them in the future? That's possible. But the moral of the story is Waymo's ahead in this. They have cars today in several different markets that you can get into with no driver inside. It'll take you wherever you need to go. Tesla does not have that. And so to tell Tesla has that, Waymo's ahead in this. And so given what we heard yesterday about 2025 potentially Tesla having it in Texas and in Texas, in California in regards to Model 3s and Model Ys driving folks around, that's good news. If that holds up, right, we'll see what happens there. But we're still behind, right? By next year, Waymo is going to likely be in a lot more markets and partnering with Uber as well in many of these other various major cities. So Tesla's behind. We got to catch up, and we got to catch up fast. And so then when Elon Musk is talking about that Robocab is not going to go into production until maybe he's talking about hopefully before 2027, we don't want Waymo to get too big of a lead here. Because if everybody gets used to getting in Ubers through Waymo, right? Or getting into Waymos, I should say, through Uber, and they get used to that in all these big cities over the next couple of years before Tesla really launches, then when Tesla goes to do it, it's not going to be very special at that point in time, right? It's already going to be like, we already been doing this. And then they already have become the brand name there. So the moral of the story is Tesla has to move at rapid pace. And I do believe there's a lot of folks that just don't feel like Tesla's quite moving fast enough in regards to this, right? Which is why you're seeing the stock sell off heavily today. So, yeah.
That Waymo has relied on: trust and technology. Waymo's technology more proven and more expensive, potentially making it harder to scale. Tesla is promising an unproven combination of tech that, if it does work, has potentially higher rewards in terms of cost per mile and scalability. Now, sure. Trust is going to be just as important. As part of our Tech Check Weekly deep dive, we polled some people in New York where robotaxis are not yet available.
I wouldn't trust it.
I just kind of believe that the car should be driven by a person.
I can imagine, especially driving in Manhattan, how a driverless car can navigate people crossing, right, bicycles going the wrong way, e-bikes everywhere. Right. I'm amazed how that can happen.
I can't imagine. These are all people who haven't yet tried it. But here's what we found in San Francisco, where Waymo robotaxis, they're
I spent a week in New York City this summer, right? I gotta say, I don't think it was a hard market to drive in. That's just my personal opinion.
And they're available to the public.
Definitely a magical experience.
I actually felt much safer getting in the Waymo than I do in just like most cars.
I heard about this when I was a kid, but it's here now. It's kind of crazy.
The key difference, Kelly, those that have ridden in a Waymo robotaxi, they're largely converts. I keep hearing that word magical come up among people who've tried it. Those that haven't, like most people in New York, they're very skeptical. Check out that Tech Check Weekly for more on the robotaxi race, how it's heating up, and where Tesla might fit in. Now, if there are several robotaxis...
I bet you that was the same... If we went back 100, 200 years ago, right, or it wouldn't be 200 years ago, 100 something years ago, right, I bet you there was a lot of people like, I'm not going to have that machine drive me around. I feel comfortable with my horses. My horses are going to get me there, my horse and carriage. I don't want that machine. That machine might malfunction and go crazy, right? So, yeah, I'm sure if we went back to way back in the day when it was the conversion from horses to autos, I bet you there was a lot of people saying these same exact things.
That are able to do this a few years from now, Uber could serve as the platform for all of them. If there's only a couple of them, they could go directly to riders like Waymo is doing right now in San Francisco. And something that your previous guest, Connor, just said, he said competition from robotaxis is coming. If you're in San Francisco, it is very much already here and likely eating into the market shares of Uber and Lyft.
Double man on the street, a round of applause. I love that, the contrast between San Francisco and New York. Yes,
So in regards to Waymo and Tesla, those vehicles, generally speaking, from what I've seen from what Waymo has and from experience in Teslas, generally they're going to err on the side of caution substantially. Like if you need to get somewhere as fast as possible, probably don't take those. If you want to get somewhere as safe as possible, from what I've seen, they're actually pretty respectable when it comes to that and probably actually much safer than a lot of drivers.
Question on that, Deirdre. Is there any word on when this could be coming to New York? I was driving there home from Fast Money yesterday. It's incredibly nerve-wracking when there's people biking within 2 inches of your car at all times.
Yes, and I think you heard that in some of the man on the street reaction is how in the world are these robotaxis going to account for bicycles, for pedestrians that jaywalk? And all I have to say is try one here in San Francisco. You will see that it operates very similar to a human driver, in some cases safer. As to when it's going to roll out more broadly, I don't know. They're expanding quickly in the Sun Belt. These vehicles still have challenges when it comes to snow and heavy rain, but I did get a view of the latest Waymo vehicle that's being developed right now with Geely's Zeekr cars. And it's so interesting, Kelly, these LiDARs on it, they have little windshield wipers and they have heaters. So they are already trying to solve this problem. It's interesting that it's like physical. You need windshield wipers, you need heaters to do that. But I mean, that's how they started. That's how they've racked up 22, I believe, million driverless miles. Wow. It happened slowly and then all at once, which is, I think this year will go in the history books.
We got to go. But you just dropped a little bomb there. They're partnering with a Chinese car maker. Wait, we'll have to revisit this maybe tomorrow. No, Monday.
Yeah, sure thing.
Interesting angle there. Deirdre Bosa.
Yeah, so the other important thing to remember is although Waymo's winning the battle right now, right, in terms of they actually have these vehicles in many markets that you can go drive in, and they're going to have it on a lot more markets over this next year or two before Tesla even really gets to their big launch. The important thing to remember is it doesn't mean that Tesla's going to necessarily lose long term. So if we're thinking about 10 years from now, it's possible that we look back at Waymo's technology and laugh at it. Maybe we don't, but there's a potential of that, right? If Tesla ends up actually pulling off what they might pull off here, they're going to get such a cost advantage that it could make Waymo obsolete over time. And that just doesn't make sense because those vehicles are so expensive compared to what it is to, let's say, produce a robocar or whatever we want to call it from a Tesla side, a cybercar. So I think that's important for everybody to consider. You know, if you're thinking short term, no doubt Waymo's winning here. If you're thinking long term, there's still a potential. The jury's still out on if Tesla's actually going to win this market long term. Because if they pulled off, like they're going to win, and they're going to win not just by a small amount, it's going to be by a large amount. Consumer spending falls in September after 7 straight months of gains.
Consumer Steve Leisman joins us with the latest results of the CNBC NRF Retail Monitor. And Steve, what'd you find?
Beck, it looks like consumers have taken a break between the strong holiday spending season, strong summer season, and the holiday season, with the CNBC NRF Retail Monitor registering a decline after 7 straight months of gains. The Retail Monitor, powered with actual credit card spending data from Affinity Solutions, shows spending down 0.3% when taking out auto and gas. That followed a half-point gain in August. Spending grew 0.6%, a meager 0.6% year over year. Taking out restaurants, what we call core retail, shows a similar 0.3 decline and a 0.9% year over year gain. The decline was broad-based, with only 3 of our 12 sectors showing any gains. Take a look at some modest gains in there. Non-store retailers, that's digital sales, up 1.6%. Clothing and accessories up 1.1%. You may remember there was quite a bit of inflation in the apparel numbers yesterday. Health and personal care, a meager 0.04% gain. Gas stations were down. Furniture and home furnishings were down, along with building and garden supplies as well. Our initial read of the data is that it was too early to pick up any effects from Hurricane Helene, though there could have been some impact at the very end of the month. Hurricanes, of course, can boost spending ahead of a storm's arrival, for example, in building supplies and food, reduce them, and then see them increase somewhat again as rebuilding begins. If it wasn't the storm, well, it leaves open the question of what prompted the drop. Spending has been relatively robust through most of the year, but weakened a bit from August. In August from July before turning negative this month. Economists have been forecasting a spending decline in the aftermath of the pandemic that hasn't really appeared yet. Well, NRF economist Mark Matthews tells me September is historically one of the weakest months for retail sales since it's sandwiched between big summer spending and big holiday spending. October numbers will probably have some real impact in there from both Helene and Milton. NRF economists also see consumers in.
So important to understand about consumer spending as far as this year goes. The numbers, even if you factor in inflation, still aren't very exciting, which shouldn't come as a surprise. Like consumer spending shouldn't be great this year. You're coming off the 2022 and 2023 inflation, right? So I feel like this is not a good setup for the consumer, really. I feel like 2025, a whole different situation. I'm actually expecting consumer spending to be relatively strong, especially if unemployment stays in the fours all of 2025. I would expect consumer spending to be booming essentially in 2025. And the reason being is you're coming off of finally a year where inflation doesn't slice and dice people of 2024, right? Which sets up spending to be pretty darn good in 2025 from the consumer, specifically the bottom 60% of income earners. So once again, the employment market has to hold. Employment market holds, I think consumer spending setups up phenomenal for next year, which is going to benefit a lot of the big multinational brands in a substantial way. And you'll see a lot of those lagging dividend value type stocks that have been doing nothing for the past 2 years. You'll see a lot of them come back to life in 2025 in a major way.
Shape with low unemployment, real income gains, and low inflation in the goods sector generally. So guys, we're going to be working with Affinity and the NRF to mine the data for impact of the hurricane, both on the states that were impacted and the broader national effects. We haven't done it before, Becky, but we can actually mine this data down to the county and zip code level.
Wow. Steve, that matches up pretty similarly with what we heard from Bank of America and their surveys that they do on the consumers that they have access into, seeing what their spending patterns are. I guess at this time, not knowing what any wobbles in the data mean, you've got to wait and see if it was an impact of these storms. You got to kind of hold out and see a little bit. Does that lead the Fed to a position where they might actually pause because they don't know if this data, exactly this data is telling them at this important time? And I did hear your interview yesterday with Austin Goolsbee. I know you tried to pin him down on that, and he kind of wiggled out, didn't want to answer it. But what are they thinking? Yeah, you did try. Valiant effort.
Yeah, you got to try. But here's the thing. I don't think the Fed pauses here because I think what the Fed is doing is not really related to the current data. I think the Fed, look, Powell used this phrase recalibration 11 times. I take him at his word that he's recalibrating, which means that, to me anyway, that you're not adjusting data for the current data. The amount and pace of your cuts is going to be dependent on the data. But the idea that you want to bring it down towards a more neutral level tells me they can cut a quarter and not worry too much about getting too close to the bone, so to speak. And just to make a quick comment on the first part of your question, Becky, we're not going to know what's going on in October either. We're going to work to tease it out. I'm not saying it's going to be perfect. We're going to try to see what we can find, but ultimately, it's going to the data in October from employment to GDP to inflation and also retail spending is going to be, I guess, distorted by these hurricanes.
Hey, Steve, just on general principle, and you can tell me absolutely not, and then I can see a reason because of our huge built-up debt. I can see a reason why you'd want lower rates because we're spending so much on interest. But do you think the Fed is complicit or has to take any responsibility at all for sort of enabling us to get to $37 trillion and just keep rates higher just to try to put some type of governor on what we keep spending? Isn't it, the minute they make it easier again, it just seems like it greases the skids for more of the same thing. Should they take any responsibility, or is it better to lower rates so that we're not spending so much on the interest accruing?
Joe, I have a slightly different take on your question in terms of my answer here, which is imagine an arm of Congress keeping interest rates high because it does not want Congress to borrow.
Yeah.
I believe that would be completely out of bounds for an arm of Congress to do so. You can imagine an executive branch doing that. Maybe the courts can do it. I don't know who can check Congress, but the Fed works for Congress. The Fed answers to Congress. And so if Congress is displeased with the extent to which interest rates are low or high, it has the ability to go and change the Fed's mandate.
So they can't
there's a
say
reason why the Fed.
Yeah, 100%. I mean, it's just, it's so unrealistic. At the end of the day, here's the thing. A lot of people say, they'd love it if, the government didn't spend so much and all these sorts of things, and they point out our debt. But you wouldn't actually want it. You wouldn't actually want it because it would be devastating to the economy. I can tell you that. If the government decided to stop spending such a ridiculous amount of money, I could tell you it'd be devastating to the economy. There's so many jobs that are produced from that. There's so much money that is put into circulation because of that insane amount of spending. So it might sound good in theory of let's get the debt down and those sorts of things. But I'm just telling you, the reality around that would be a major, major recession that would last likely a long time. And then what do you do coming out of that? Well, you're probably going to spend insane to get out of that situation, right? And if you don't spend insane to get out of that, you're going to be in a downturn for years and years and years. You're in a downturn for years and years and years. What's going to happen with the politicians? Well, they're going to get voted out of office, and new guys are going to come in that will basically tell the public, we're going to spend. We're going to give you this. We're going to give you that. We're going to do stimulus. We're going to do tax cuts. This and this and this and this. This is why as far as politics go, no one talks about, we're going to bring down the debt. That's not going to get you votes. What's going to get you votes is look what the candidates are running on, right? Tax cuts. Free college, all this stuff. Look at both of the candidates you have up there. We're going to give you this. We're going to give you that. We're going to give you this. We're going to give you that. We're going to do this. We're going to do that. Neither one's running on any sort of big campaign about cutting spending or we're going to cut the debt. No. That's not going to get you votes. Okay. My son recently, my oldest, he had basically a thing for his class of running for governor. And so his points he ran off of were these points that they might be of interest to grown-ups, but these weren't really interesting to kids. And so he only got one vote. He didn't win the governorship of his class or whatever. And I told him, son, the reason you didn't win is because you gotta say things that are going to resonate to the 10-year-olds, right? Tell them you're going to limit how much school has to be done, and tell them you're going to, make it so they don't have homework to do on certain days, and make it so everybody gets chocolate bars once a week. You do those sorts of things. Okay, now you're going to talk about your classmates are going to be voting for you. But doing the sort of things he did, it wasn't, let's just call it didn't resonate with those folks. So, yeah, man. All right, next one up here. NVIDIA is the most controversial and biggest opportunity, says Goldman. Ooh.
Joins us here at Post 9 today, Goldman's head of derivative research, John Marshall. John, it's good to see you.
Thank you for having me.
You want to talk about last quarter's list and how the performance was?
Last quarter did go very well. Many of the names that you brought up when we were discussing things last quarter were among the leaders. Affirm, Starbucks, Guidewire, they were all on the list and did remarkably well last quarter. I think it's a testament to our analysts, their estimates, their ratings, and their ability to find some of these idiosyncratic stories.
We've talked before about how you cull it from a large sample to a smaller, then smaller and smaller, but what are the general parameters that you're looking for to screen?
Yeah, it's a great question. So we'll look for things like what is their rating and price target, but we're most focused on their difference between them and consensus on earnings estimates for next year. We find that's where they spend a lot of time making these estimates and they add a lot of value. And so we'll find the top 150 or so, and then we'll go out and talk with the analysts, understand whether those views are really current, what are driving those views, and how strongly they feel about them to get it down to the list of 25.
All right, so let's name some names. Where's the biggest opportunity this season?
Well, I think one of the most controversial and biggest opportunities is definitely in NVIDIA. Our analyst Toshiya Hari just raised estimates this morning. He is now 14% above consensus for next year for NVIDIA earnings. He has a very strong view on the idea that their near-term products are doing well. You can still debate the ROI of AI and Gen AI over time, but over the next year, he's seeing really strong fundamentals to drive that one to the upside.
So it's not in the stock, you're saying?
Correct.
What else do you guys like?
So yeah, as far as NVIDIA goes, I've always imagined that kind of going 150 to 200 before year end, but then potentially like kind of multi-year topping essentially. In regards to that one, because we know 25 numbers are going to be a banger, but I think 26 is going to be a hard year to get any sort of major growth. And when I say major growth, I'm talking over 10% in 2026, which I think is going to be a real letdown for a lot of folks. So yeah, 2025 numbers are set. Like it's going to be a great year in terms of the fundamentals of NVIDIA. The question marks start rising in 2026, but I think NVIDIA could potentially have a blowout quarter this quarter and guide very well, which would help benefit the stock in the short term and maybe push it into that 150 to 200 range, like I'm thinking, before year end. And then next year could kind of be like kind of a boring year in regards to stock, and then you could be looking at potentially a downtrending year, maybe in 2026.
Along that same theme, Broadcom is another name that Toshiya likes. It's on the list. It has about 6% upside to its estimates.
That was a disappointment last quarter, I think.
Yeah, we're thinking that the broad trends are going to lift it, particularly Toshiya's view on the networking part of AI, which is really where they come into play.
Couple financials in there, right?
Yeah.
Synchrony and Citi. Can you talk about what you see?
Yes, so Richard Ramsden on Citi. It's also on our conviction list. He sees upside to estimates. Part of that is cost savings. Part of that is...
So in the private stock group today, I was speaking about JP Morgan's earnings, and I was going through JP Morgan's earnings, and JP Morgan actually looks pretty good. Like if you've looked at their numbers throughout the year, essentially, I kind of went into detail in regards to the private stock group here today, showing them kind of what I was looking at. But basically the gist of it is throughout the year, things have gotten a little better than expected for JP Morgan, which is really good news, especially for the big dog financial out there. You want to see things get better and better and better throughout the year. Net charge-offs are actually under where they started the year, kind of expectations there. Net interest income is better than expected. So yeah, definitely good as far as that goes. With that being said, I don't love financials here except for one financial. Do you know what financial that is? That is SoFi Technologies. That's the only one that is interesting to me. All right, guys, appreciate you joining me as always. Thanks so much. Today, for a pinned comment down there, I'll put my Instagram if you want to follow me on IG, and I'll put my X, formerly known as Twitter, if you want to follow me on there if you use either of those platforms. Additionally, the description area, that's where if you want to join my Patreon, see the stocks I'm buying and selling each week, or whether you want to join my private stock group, get access to all my best course curriculums, teaching you everything I got up here, my private stock group's Discord chat, all that good stuff, that will be the first link in the description area down there. Much love and have a great day.